Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 2nd, 2023. It is 12:07 p.m. Eastern Time as I'm starting the video. This is video number 2 of the day, and what I'm going to do in this one is an update on the rest of us, so meaning my whole theory about a bear market for the rest of us, focusing in on the S&P 500 and Dow stocks, those stocks that really didn't get the memo on the bear market. The bear market was led down initially until recently by tech. Tech is rallying now. That's where the charts were most constructive, and just want to do an update on those stocks because, as I said, I think the best thing to do right now, one of the best things, is to be selective, go into stock picking mode, be long the most bullish stocks, short the most bearish, and or sectors, and of course asset allocation. It's not just about stocks. You can be out of the market and have trade commodities, gold, silver, crude oil, natural gas, wheat, soybeans, spread it around. That's the key to investing. What I'm going to show you here real quick, this is a 15-minute chart. I told you I feel pretty strong that we'll have a fade into the close today, some profit taking. And just for those interested, it's about a 2% pullback to where I think we'll be today if you want to take a quick trade right there. This is a 15-minute chart, I'm sorry, of NQ negative divergence. The other video I showed you were at resistance on many of the market-leading FANG stocks, and so that's about a 2% pullback. The zone, really a target zone of about 12,553 to about 12,498. We'll call that 12,500. That's where I think we'll be today, at least before the close. And then if you take any shorts into the big three earnings tonight, Apple, Amazon, and Alphabet. Gosh, I keep wanting to say Google. So many years that we're Google and Apple, Alphabet, and Amazon. There's a lot of A's in there. That's where we're probably going to go if the market does not like what they're selling tonight. So you'd want to, if you're going to game a quick pullback and hold it. I don't think we'll get there before the close because that's an aggressive drop. That's about a 5. Well, let's see. Today, we can go through here. Well, if you see at the bottom, there's the time right there. So let's say there's the market close at 4. So that would put us down by 2%, a little over by the market close. And where was I? Nope, that's 12 through. That was, okay, I'm on military time down here. So I got to go to 1600. There it is. Yep, right there. That would be something like this down to the close, and then if they crap out tonight and down into tomorrow, that's where we're likely headed. And again, just revisit that last video. I showed you the resistance levels and the fact that it's it is a crapshoot to take any positions into earnings tonight, but that's the way it's most likely to go. I think at least a pullback to those levels. And if you are bullish, remember, that may, if you're looking for a pullback to the test of 200 days or support levels, that may align with that. This is just a short-term chart. Again, 15-minute chart NQ. But the point of the video was this. The Dow, which is significantly underperforming. You have the QQ. Look, the Dow is only up 0.5%. Remember, I've been covering the Dow, even though I don't normally cover it, because the S&P 500 has 500 companies within there. And although I could sit there and go through all 500, it'd take me hours to do so. I can't do it in a video, so we'll do the Dow, which is kind of a little mini S&P, if you will, with just 30 stocks. But you can see the Nasdaq 100 up 3%, and yet the Dow, which is as small as that is, only 30 companies, the Dow is more representative of the U.S. economy. See, the thing about the Nasdaq 100 and why I trade it, it's tech heavy. It's like trading almost just pure tech stocks, and it's more of the tracks the stock market. It's a little more higher beta, because the same top components in the Nasdaq 100 are the top components in the S&P 500, and in most of those, but not all, are also top components of the Dow, namely Apple and Microsoft. But But the easy way to look at it, they say, you've probably heard the expression, the stock market is not the economy. The S&P 500 and Dow much more closely reflect what's going on and what the economy is saying, where the economy is likely to be going, because the stock market tends to look ahead. I've heard anywhere from 6 to 9 months, and I've heard just weeks, depends on the environment. But in this environment, it's more of a rapid macro, kind of rapidly changing macro environment. But either way, here we go into the charts. So the Dow was the stronger index, and the S&P for a while. It took just till recently the tech stocks started to play catch up, and as expected, that was sector rotation. I said it favored tech stocks outperforming the Dow, and that's very, very much what happened. And today is just one example where the as just showed you, the Nasdaq 100 up 3%, yet the Dow is down 0.5%. And it's just out of curiosity, the SPY is probably up. Yeah, SPY has better weighting in those top tech stocks than the Dow. Then that's up 1.3, but still significantly underperforming the Nasdaq 100. So let's go into the components. The recap. If you haven't seen the recent videos on the Dow, I've covered some of the more bullish and some of the more bearish stocks. We had this downtrend line, which we took out there. That was bullish. Put in a divergent high. Nothing goes up forever. Came in for a perfect back test, and we've moved up. So far, if this marks a significant top and we start to move lower, then here's how it looks. You have a longer term bearish downtrend, although that starts to get called into question when you take out these previous highs. We have yet to take out that reaction high, and of course the all-time high. But the fact that we did take out that high, again, it doesn't mean that the downtrend's over, because you still have this reaction high, and then that one, and then that one. But it does call it into question. However, you can see we took that one out, and since then, so there's the kind of longer term trend, the intermediate, which is bullish. But then the very near-term trend, you can see so far the Dow, unlike the Nasdaq 100, is making lower highs and so far lower lows. So, from that perspective, if it can rally up here, take out this high, and then of course this one, then that's going to be bullish, and that's going to say the market's most likely headed higher in the coming months. However, should we take out, we have these little mini trend lines. You tend to go up and then break, and that's probably the most recent one, and this one's a little more important. So we'll watch this. Just watch this going forward. If we take out that downtrend line, do we take out that low, and then do we take out that low? And then of course you have the 200 days, and that might tell us that we're going to go lower. And ultimately, if this happens, that's why I'm doing an update here. It's going to ultimately put pressure on the tech stocks. The tech stocks right now, it's a FOMO trade. Again, it's a trade we were in early. I got out a little early, and that's fine. Now everyone else wants to buy because they see, Tesla up 50, 60% in the past few weeks, and Amazon and all those other ones rocking. Again, they're, like I said today, the risk reward's no longer favorable. All right, I will do this video quick. We're going to go over, I've already covered Apple quite a bit recently, including in today's earlier video. It's at within close proximity of its 200-day moving averages, and pretty decent price resistance zone right here as well. They report tonight, so we'll pick this up tomorrow. Microsoft is right at the downtrend line right now, the potential downtrend line. And just one day above, it closed just below the 200 days yesterday. It's up today, and on face value, that's bullish unless it takes out those 200 days. If it has a reaction, if it pulls back, and what would likely cause a pullback if any of the big three or all three of those take the market down tonight, I'm talking about Apple, Amazon, and Alphabet, then that could cause Microsoft to come back, and ideally it should hold above the 200s. And so again, something to watch right now. I'm just going to go over the Dow, say I have, my thoughts there. It's probably going to head back down next week is my guess. Visa's been strong. Got to give it that. We took out this downtrend line. That was our bear market downtrend line. There's your bear market downtrend, and strong off the lows. However, you can see it is diverging negative divergence right there, and it's very overbought, and it's coming up on big resistance. That's why I have it color coded 236.57 right there. You have major, once the top was in, you had a couple reaction highs that were very, very distinct and clear reaction highs, very obvious. And there was also one right there. So that proved to be a little whipsaw false breakout. That's the level to watch. And again, overbought. I put very high odds that at very best. I mean, if you're, I don't, I not a big options guy. I've dabbled in them over the years. So I prefer to trade shares, individual stocks, and/or futures. But what I would tell you is this one, at the very least, it's likely, like my outlook on the market, to kind of stall out here and go nowhere. That's my most bullish scenario. So you could sell calls on that, things like that. Covered call selling is one strategy where you own a stock, you sell calls on it to generate some premium. But that's best case scenario. Worst case says these divergences play out, and I think that's likely. And then you have the potential for a big old rising wedge right there. And then you kind of got to go to the long-term charts. I'm not going to do that in this video, but look at the long-term charts, and you can kind of gauge if they're going down a lot further. UNH I was clearly bearish on, showed you recently. It's one I've been watching for a long time, and I got a price alert not too long ago. In one fell swoop, it took out multiple key support levels. If you can see below, I'll turn the lines off so you can. You had the key 200 moving averages. Like I said, some stocks behave better on 200 days than others. This one does a very good job. It is bearish when you take out below it, and that was a big drop. You took it out there. You had a big little bear market in the stock, big correction, COVID right there, and it's just done a phenomenal job of acting as support. Those lines were taken out along with that nice, well-defined uptrend line there, clean reactions. And so what I'm doing is following up on this. Is the if you're trading a well-diversified long-short portfolio, that's paying off. There's the little consolidation around that 489 target, rally back up to the 507 support, former support, now resistance, with a couple rejections. And also you can see right there, boom, boom, two rejections off the 200-day moving average, the exponential, and then this is a resumption of a bear market. I'm sorry, a resumption of a correction. This is TA 101. You take a breakdown, nothing goes forever. You consolidate around the first target or support, and then after the consolidation, the downtrend usually resumes, and that's still my next target, 448, and then 443. J&J, this one I mentioned as being bearish on. Again, I've been covering these for a few weeks. I can't recall, but I believe this was still in the uptrend line there. Sell signal yet to be triggered. That negative divergence right there. Sell signal was triggered, and it was good so far for about an 8% short trade, right down to that 162 first target, where it bounced as expected on the initial tag. And once we take out the recent lows, remember, it overshot it. These are what I call momentum fueled overshoots. Actually, ironically, well, not ironically, they were intraday pierces. Momentum fueled overshoot is when you have a lot of momentum. It's what I call it, heading into let's say coming down on the support level. You tend to shoot through there only to snap back up, and then you parked right above it, right on it, that 161.91, same level I had before. Then hit it the second day as well, closed the candle, the body was there, closed up top. And so again, now that we've had those two momentum fueled overshoots, that's the level you need to take out, and that would open the door for a move down there. Let me tighten up that next target for you, because these were just kind of initially I was sharing them as trade ideas, but also analysis. I'm going to give you, that's the level now if you're targeting this, if you're short J&J, 155.85. And again, the theme here is the rest of us, really the economy. When you start to see, it started with tech, and that's how the last bear market in 2007, 2009 started, and it's how the one before that in 2000 started. Tech led the way up, and tech started the way down, and then the rest of the market finally cratered, meaning the economy rolled over. And we all know that mostly so far, the majority of the big layoffs have been in tech. Big tech hired a lot when COVID hit. They're laying off. They're back down to pre-pandemic levels. And again, tech doesn't move the needle as much in the economy. It is very much so in the stock market. So really, if you trade the stock market, all that matters is what the stock market does. In other words, you can be complete bear on the economy and then bullish on the stock market and make money. And that's all the important thing is. You could be wrong on your call on the economy. But again, it depends what index and what stocks you're trading. And so what I'm looking at is deterioration of other sectors and stocks. So the other one that was and still am bearish on, JP Morgan here. Again, I'm going through the top components, so all the components of the Dow, but in order of market cap. And so JP Morgan, very clean, clear bearish rising wedge, broke down recently, a lot like that GDX trade, a breakdown, back test, and that was also and is pretty good resistance, about 141.12. And so this one I can say with conviction, strong conviction, it's still an objective short entry. If you miss the breakdown or the initial back test, you can short it here with a stop somewhat above. I can't promise it'll play out, but I can promise you I like the setup and I think it'll play out. And there's your first and minimum target, 129. That would give you, if you shorted it where it is now, you'd get about a 7.5% profit to that first target. It also comes in with a 200-day simple moving average. And well, if it hits that target, and I'll let you know if I think it has more downside to go, if and when it starts to get there. Walmart, kind of big picture. We have to roll back a little here, zoom out. This trend line even goes to the left of the chart over here, so all the way back into 2017, probably primary major bull market uptrend line for Walmart. Broke right here. That's a major sell signal. Back test 1, back test 2. And it's setting up in this minor trend line. No update since the last, pointed that out before. We're waiting for a break of that to trigger a sell signal, and that would take us to minimum 128. And then after 128, I'd expect a likely reaction there down to 117.20, or we'll call it 18. Well, roughly one. Yeah, I had it. I moved it. It was about one. We'll call it 118. All right, let's leave it there. And then ultimately probably down to 103. And if that happens, that's most likely another leg down the stock market. To see Walmart drop that much, it'll tell you that the economy is continuing to soften, et cetera, et cetera, et cetera. Otherwise, look, that's the bear case, and there is no sell signal. There's no reason to be short Walmart, especially now it's at support. If anything, you buy support and then you wait for a break of support. And look, if it can take back the trend line, clearly get above there, take out the high, well, hey, that's bullish. That was just a bearish setup that never materialized. It never even triggered a short entry. All right, so one to watch. And I think I already have an alert. I do this throughout these videos, but it doesn't hurt to have multiple. There it is, just to let me know if and when that breaks. CVX, that was clearly bearish one. We have this primary uptrend line right here that's going to be a big deal when broken and really start to gain. I think that'll start to get some downside momentum going in the energy sector. Shorter term, I pointed out the other day, we broke out. We put in a divergent. We had a divergent high here. And again, it's not as if these divergent highs don't work or play out. That was good for a drop of, that was a 29, almost a 30% drop right there, followed by a bullish falling wedge. It came right back to the 200-day moving averages and the uptrend line. So you got a rally, another pullback to the trend line. Look at all these reactions on that trend line. And then most recently, another divergent high. We had one right there as well. That was also a divergent high correction, divergent high, and then boom, sell signal on that trend line break coming up. And why this is a really nice setup is if you take out the primary uptrend line, you're also going to take out these pinching 200-day moving averages right there. And so that's what I call a BOD, or benefit of the doubt support level. Probably get something like a breakdown, maybe a back test, maybe not, but either way, a break of 152.50-ish should send it down quite a bit further. BG, Procter & Gamble, this one I highlighted as bearish recently. With that trend line break right here, you had a steep up trend line and then it broke, pushed on, made a marginal new high, and then consolidated for a bit. And once it took out the bottom of that consolidation range, boom, right down to that 138.60 target. Bounce, back testing this trend line. Also looks to be maybe flagging right here. That's a bear flag continuation pattern. Impulsive leg down being the flagpole right there. followed by an area of consolidation that takes the form of a flag, back to resistance, the 200 days as well, and then if a flag breaks to the downside, that should take us down another leg down in P&G. And if it does, again, the takeaway is these are blue chips, so far, not too far off the all-time highs, and that's why I singled out the Dow and the S&P for again, those stocks that really were trading near their all-time highs, and not to say it didn't have a leg down in the bear market, but not nearly as much as a lot of the tech stocks. So there's P&G. Home Depot, give it some points. It's not the best defined trend line because you only had 2 reactions. There was no reaction there. You just popped through it. But what I can tell you about Home Depot with conviction is 344 is pretty big resistance. Bullish, yes, if it can take it out. Bearish if it doesn't. And the fact that I think and I'm seeing more and more sectors and stocks outside of tech start to roll over, wouldn't be surprised to see this one get rejected there. So just watch it. I don't have a strong opinion. I wouldn't short this one. You can make, I can tell you all day long it's an objective short anywhere right now all the way up to 344, but not above, with a stop placed somewhat above it there. And you'd want to swing down. What it's doing, it's starting to set up possibly in this trading range. So again, whether if you do short it there, whether you cover the bottom of the range or hold out for a breakdown, and then any of these potential targets would depend on what the rest of the market's doing. In other words, if the rest of the market and a lot of the stocks in the similar sector are holding up at that time, you'd want to cover that, pull back to the bottom of the range at 310.65. If tech gets rejected hard off these 200 days and trend lines that we're at now, the market doesn't like what Apple, Amazon, and Alphabet are selling, and we start to take an impulsive leg down, then yeah, Home Depot is probably going to go down and also make another run at and maybe take out those previous lows. Merck, this one highlighted as clearly bearish recently and said that was one that was just waiting ripe for a breakdown. It did. It broke, back tested. If you missed one of those 2 entries, then you had the next one highlighted on a break under 108.73. It broke that as well, and it's been just back, getting rejected on this trend line, coming up to that first target there at 101.65. And ultimately, still think it's coming down here. You've got the 200 days, and next target after 101.65 is taken out, 98.15, and then 95.24. But again, a story of the stocks that we're doing great. Sector rotation, money moving out of tech. Out of the pharmaceuticals and healthcare and the other sectors that were doing good. Now moving into tech, we're just seeing textbook sector and stock rotation. All right, KO, Coca-Cola, trendline break, stair stepping lower, kind of flirting with the 200 days, but it's below them. Here's the 200-day test, 200-day. This one tends to go down and through them a little bit, so I don't have a strong opinion on Coke, but could be flagging here, a little move down, a little bear flag, and if so, that would take us down to that 57.62. So watch for a break of the recent lows. Cisco, like all things tech, stronger than the rest lately. Remember, the Dow is made up of tech stocks. It's more diversified among a lot of different type of sectors, but breakout. But you could put a BOD. There's a little candle a little bit higher there when we had this divergent high. So I could drag that trend line a little bit higher. You also have a reaction high. I don't have a big opinion on Cisco other than to tell you that we're in close enough proximity to that trend line, and if I dragged it a little higher to get the top of that candle, that reaction high, and a pretty big resistance zone there. Nike at resistance now. These are all the same levels I had. I don't think I've modified any of these charts since the last update. 131.18. I can't make a screaming case to short it or to go long. Wouldn't go long. I certainly wouldn't go long, especially if this is a bear market with the stock overbought and at resistance. If anything, you wait for a pullback, maybe to that 119. That's about 120 level, and or this uptrend line, which come in about together. I'm going to make that 120 rounded off for you. There it is. All right, so that would be an objective entry, and of course, if we go back down there and then we break that, then that's bearish. That means most likely another leg down in the market. Disney, this was one of the bullish ones. I gave you this as a long setup. Even took this one personally, took it up to right here, the trend line, laid out all these targets and told you back then it could potentially go up to 127.58, one of the better looking stocks in the Dow. I don't know why my MACD is there. Turn that one off. PPO, positive divergence, breakout right there, and but it is now struggling with the 200-day moving averages. Like it got rejected there, and it's still right there in close proximity with a very steep uptrend line. This one, you know, if you took it, I would have a stop not too far above this trend line. When we break that, you could even short it or buy it on a pullback to the back test the trend line there. But I think a break of this trend line is going to take us down lower. So I think we milked most of that. I forget exactly where I threw it out to you, but it's up about 27%. I think it was in the middle of the wedge here a few weeks back. McDonald's working its way lower. Another one that I think they're, the market snipers are going to come out and get. The bear market snipers looking for these big stocks that have held up. Really not one of my favorites. I have no desire to trade this one, but it's kind of stair-stepping lower recently. Again, that's a common theme. A lot of these former or recent leaders up into, come in the stock that was an all-time high right there. Since then, it's been stair-stepping lower. That's just a near-term downtrend and a longer-term uptrend. So really, until and unless if you see McDonald's come all the way back down here to 230, that's a big level. That's really the trading range for the last year and a half right there. A break of that would tell you we're solidly in a bear market, I believe. You need to see not just McDonald's, but a lot of other stocks come in and take out, comparable support levels. Verizon, had a divergent low. It's been stair-stepping higher. Let's get some resistance here. I don't have much of an opinion on this one other than putting in some divergence here. Roughly equal high. Oh, and you can see it's also coming up on the 200 days. Once we took them out back here, we were in a bear market. Rejection, rejection, rejection. Little false breakout, a lot like what could be going on in the stock market. We'll see, where it takes them out for a few days. It's impulsive. It looks like the real deal, only to get smacked down with a violent rejection after they fail it. So just like the stock market, the QQQ, Apple, Amazon, the S&P 500, if you see something similar, just realize that it could be a swift rush for the exits on the downside if that happens. But sometimes you break out and you stick, and the breakout sticks. But this one keeps getting rejected, and it's coming up. It's not there yet, but just like some of the FANGs, there's a little more upside to those key moving averages, and probably give a downtrend line as well on it right there. Yep, there's your downtrend line, comes right in with them. So that is a very objective shorting entry or an exit on longs, because if you get there, you're going to have negative divergence as well. So there's your upside, and that would be your downside target, minimum 39.32. So a little upside pop on Verizon would be an ideal short entry, and that would be good for an 8% pullback target if you get it. Okay, next up, CRM. This one I was bullish on and threw out as a long trade idea. Back here, Salesforce.com, and we already hit my first target recently, 166.55, and I gave you 2 targets on it. And so we made it almost about halfway up to T2 so far, and that's the final target at this time. And it's getting a little extended, but like a lot of tech stocks, it's taken out the 200 days. It's taken out this resistance, that first target. And so, if we get a pullback to T1, that may offer an objective entry or the 200 days. And we'll just leave that one on now because that's coming off a big divergent low. That was a nice looking setup there, in my opinion. Honeywell, another one that's held up relatively well, but recently put in a divergent high, walking its way lower, and probably going to head down for a back test to the downtrend line right there. Amgen, bearish. I was bearish on this one. It was another biotech. Had a little area of consolidation, a break of a steep uptrend line there. Ran down, hit that first support level there, 158.30, bounced, and now it is at trend line support. So if you took this one as a short trade, it is at uptrend line support, and that's probably going to give us a bounce here. That's my guess. I don't see this one going a lot lower. It's possible, but that's pretty good support there. Caterpillar threw this one out as a short setup, break there, and it's been moving lower. Already hit our first target. That's hit. Um, yeah, well, you know what? I can't recall. Maybe no. Maybe I had this as first support level, 245.95, and that's the first target, 238.75. Yeah, I believe that's what I laid out as the first target, with the second target here, 226.30. But there's, beautiful bearish rising wedge. And here, it's another example of a stock at all-time highs. Didn't get the memo that we were in a bear market recently, so this is what they're coming after. They're selling CAT, and they're buying Apple and Microsoft and Amazon today. And keep in mind too, and if this is a bear market rally with more downside to come, this is what happens. The explosive rally in the tech stocks recently, that is very, very, very typical of a bear market rally. It reminds me of November 2008. Looked up that period, look at the gains, look at the price action, look at the charts. No different. And then boom, look what happened after that rally ran its course. And so that's probably what's going on. Just remember, in bear markets, everything tends to speed up. The rallies are powerful, the corrections are powerful, usually faster than they are, and so you have to be a little more nimble than you do in a bull market. So Caterpillar is still short with more downside. American Express, I'll give it some points. Broke out recently of that downtrend line, 1, 2, 3 reactions. And yeah, I don't have an opinion on that. That's more bullish than anything. But it's kind of in no man's land between support and resistance. I wouldn't take the stock. Boeing, this one is laid out as a short setup, bearish divergent high right there, negative divergence, trendline break. And the only thing I've added to this chart since the last time I updated it was right here. I put in a trend line today, I believe. Little minor uptrend line that it needs to crack. So there was your breakdown. Still divergent high. First target still 196.41, a little above that. Remember, these are actual support levels. Cover a little bit above. T2, T3 is the first of the downtrend line, or that 173.13-ish support level there. That's Boeing. GS, it's kind of looks like an EKG recently. Little spikes up, a little minor trend line breaks. So wait for minor trend line break, probably bring it back there. It did come off this divergent low. I don't have a strong opinion on this one, I'll be honest with you, but I think next break of this little minor trend line will probably send it back down. IBM broke the trend line, moving lower since. Again, common theme, and this is tech too, but just not looking great. And it's also just a dead money stock. I mean, this is the kind of stock I don't really not might try to set up. It's just gone nowhere for years. It's like airline stocks. They go up, they go down, but over time they go nowhere. Intel, threw this one out as a setup, and it's like I said then, and I'll say now, it still has to take out 30.50 right there. I have it at 38.40. If it breaks that, T1, T2, T3, again, a setup, not an actionable trade, and it's coming up on resistance now. So watch that one. If the FANGs, if this breakout sticks and the market likes what the big three are selling tonight, yeah, maybe Intel will pop and go. 3M, last time I covered this one, I said I don't have much of an opinion other than tell you this is a textbook downtrend. Stock is just zigzagging lower, and not much else to say. It's just fresh off 52-week all-time lows, or multi-year lows. I'm sorry. Travelers was bearish on this one, laid out as a short setup, a negative divergence, and bearish rising wedge, breakdown, impulsive, hit support, bounced off the first support level. If you missed the breakout, there was your next objective short on the back test of the wedge right there, and it is moving lower. Came close, but not all the way down to that 174.63 target. And if that goes, and the 200 days, which come in just under it, if they get taken out, I think this one's headed all the way down to 149.65. Dow, it's Dow Chemical. Nothing but bullish right there on the breakout. Downtrend line right there. And also symmetrical triangle pattern. The reason I personally wouldn't take the breakout, I can't make a case to short it because divergence in itself isn't a sell signal, but there's negative divergence. And from my experience, breakouts that occur with negative divergence have a much higher rate of failing. So just keep an eye on that one. WBA, Walgreens Boots Alliance, And I put here, you know, note. That means I just do that quickly. Tells me that would be a potential left shoulder on a inverse head and shoulders bottoming pattern potential. I think I might already cover this. Right shoulder a little bigger, and that's okay. They don't have to have perfect symmetry. That would be your neckline. And what it would need to do is rally up here, ideally on increasing volume up to the neckline. Then that would be a fully formed pattern awaiting a breakout above this neckline, this near horizontal, slightly upward sloping trend line. And a measured target is the distance between the bottom of the head and the neckline. So that'd be a big measured target, and that would most likely entail that the bear market is over. At least we're going to rally. The stock market will rally anywhere close to those old 2021, late 2021, early 2022 highs. Other than that, that's glass half full, and it's still not even formed. It's just a potential pattern that hasn't even fully developed. Other than that, you can see the stocks under the 200-day moving averages and also stair-stepping lower in what is so far a bear market for it. So that is the current trend. And well, you can see I keep having a hard time grabbing my arrow tool, but that's it, stair-stepping lower. So one to watch, and that's it. Okay guys, there's the 30 stocks in the Dow. I'll wrap it up here, and let's see how we close the day, and most importantly, what happens tomorrow and in the next week after the big three report tonight. This has been Randy Finney with Right Side of the Chart. Have a great day.